crazy to say this, but the Bank of Canada's rate decision is literally only a few weeks away from us again. And the market dynamics are shifting so fast. It is nonstop right now. Inflation data is in, home sales are slowing, and the bond yields are constantly bouncing. What is going on out there? The big question that people are asking is, where are rates going in March? Is there going to be a rate cut? And is it actually off the table? So let's break down and get right into it. Not going to waste any time talking about what's happening in the economy, what it means for fixed rates, variable rates, and are we entering a recession right now? Now let's start off really quick with the probabilities, get into the good stuff. As of the filming of this video, the most recent probabilities for rate cuts were a 32 chance of a 0.25% rate cut from the Bank of Canada with a 68% chance of a no change, with the US Fed showing 2% chance of a rate cut, which is basically nothing. Just a couple of weeks ago, the traders were nearly 50-50 on whether the BOC would cut rates in March. Now, the odds have basically dropped to 32%, which basically says that a rate hold is much more likely than a rate cut in this current rate environment. And it's kind of surprising, but not really surprising. Let's dig into the data itself. But before we do that, the US Fed is even more set on rates remaining steady right now. There's only 2% chance of that rate cut in March. Again, it's essentially zero. And that means the borrowing costs in North America are not falling as fast as we currently hoped. Unsurprising with all this tariff information that's going on out there. But let's talk about what is actually driving the BOC's decision. What are the big dogs up there at the BOC actually doing, and why are they considering it? Now, the key data, you got to understand that inflation data has an impact still on what they're planning to do. But headline inflation was only 1.9% year over year. A big part of that, and that you need to know, is that the GST rebates had a huge impact on the potential of inflation. Without those GST rebates that we saw happening, they suggested that inflation could have been closer to 2.5%, which is higher than we want to see it happen. And there's many out there who are suggesting that the next inflation data reading will show a higher reading simply because we do not have that GST rebate in hand. Now, the reality around inflation is that the market is proposing, and many are suggesting, that we will see more price hikes with the GST rebate that ended in February. We're also got the carbon tax increasing in April of 2025. Yay. And whether or not you agree with it, it's happening, it's here, it's coming, and that will have an impact on inflation in our country. The reality is they're making it more expensive to make it more expensive, which is going to force inflation up. Plus, of course, if you didn't recall, good old Trump has a thing for Canada still, and the trade war is still impacting and likely to impact prices. We'll obviously wait and see how that plays out. That is still a serious consideration. Now, if you're watching this, you're probably telling me, what the heck are you talking about? Stop doing it. Talk about mortgages. That's what you're good at. So we're going to focus on that. But the reason that I am talking about this right now is because this has an impact on some of the decisions that you make on your mortgage and whether or not you should be considering a fixed rate or a variable rate in this decision. So let's continue on. The BOC's biggest concern overall is inflation. On paper, January's inflation came in at 1.9 year over year. But if you strip out all these tax rebates, again, it's closer to 2.5%. Now let's get forward and talk a little bit more about what you need to know about the housing market, because again, that's going to play into this decision. This might have been surprising to some, and I can't say that it was actually surprising or shocking to see that the listings results, so the number of listings in our country, not only did they surge, but they surged by 10% in January, like a very, very significant margin. But what happened is sales fell down 3.3%. I'd say that I'm not overly surprised or shocked about that for a variety of reasons. The numbers on, as far as inventory, they measure it based on months of inventory, and that number actually went up to the highest that we've seen in a 5-year average of 4.2 months of supply. So it's 100% a buyer's market, not in all properties, but it very much is. House prices also hit a all-time low based on sales at $670,000. I got a few theories on that. Obviously, I think property values themselves started to recover, or at least kind of flatline there in December of 2024. And then into January 2025, we saw an insane amount of people reaching out, anecdotally speaking, but a lot of the people that were reaching out were looking at entry-level everything. So entry-level condos, entry-level townhomes, entry-level houses. And that honestly has been the number one commodity that I've seen selling virtually anywhere and everywhere. But anybody who's selling at those higher price points, whether it be a condo, a townhome, a detached home, most of those properties are sitting. They're not all sitting, but a lot of them are sitting. And so for obvious reasons, if more expensive properties are not selling, we will see the overall average price point continue to go down, and that will impact the average benchmark. The question mark is obviously, does that impact the consumer psychology? Does it impact what people are thinking? Does that impact people jumping into the market because they see this happening? Or do people just say, we're going to wait and watch it continue to slow back down before it quote unquote crashes, as some people like to say? Here's the thing. Home prices, they're just not picking up like they expected. Despite seeing the lowest qualifier rates that we've seen since 2022, buyers have still been holding back. Like we said, listings surge, we saw sales drop, and inventory go up. So bottom line, the house prices are not moving, but they're also not dead. We're just seeing it that there's just bands of price points in different markets that are really, really stagnant, and some that are moving and some that are drop dead, like just quiet, that aren't doing anything. Particularly like areas like New Brunswick is up 13%, whereas BC is basically flat. So figure that out. All right, so what does this all mean for your mortgage? I mean, the big question at the end of the day is, do I go fixed? Do I go variable? Is it the right time? Why should I go variable? Why should I not go it? What should I avoid it? And so forth. So let's just break down a thought process on this. Why would you go variable in such an uncertain market with what's going on right now? Well, with the BOC having already cut rates significantly, 6 straight times for that matter, we are at a point right now where the BOC is still, even though they may not cut in March, the markets are suggesting the BOC could cut rates 2 more times in 2025. Notwithstanding what could happen in 2026. And if this happens, variable rates based on an amortization simulation, I've done these in the past videos, could save you money. And the reason I say could is because we obviously know that rates could rebound for some unknown number of reasons. And the question mark for most people is the risk worth the reward. Now, if you're also thinking about going variable, one of the big reasons that people do that is because you only ever have to pay 3 months worth of interest. Plus, if you're someone who thinks that fixed rates could continue to go down as the bond yields dip, if they do, then you could lock in at a later time at a lower fixed interest rate. Now, why go variable? Again, the rate cuts are taking longer than expected. We've got the inflation risks remaining. We've got the carbon taxes. All these different things could hold rates higher for longer. And that, by the way, is one of the reasons you might not want to go variable, just with all of that stuff in the marketplace. Although it depends on which side of the fence that you're sitting on, because many are suggesting that that could cause rates to go down. Although remember this, inflation goes up, typically speaking, rates go up with that to try and counteract that. Inflation goes down, usually the opposite occurs. Now, if you're thinking about fixed rates right now, one of the big reasons that you would consider going with a fixed rate mortgage simply is the actual rate of borrowing. Depending on the type of product, term, your situation, 25 years, 30 years, uninsured, insured, all that fun stuff. You can get a fixed rate right now for less than a variable, on average about 0.15% less than your standard variable rate mortgage, which isn't a big difference, obviously, which is again why the variable rate could win. But then you've obviously got the, you know exactly where you're at, slight reduction today, even if it's for just a month. And no surprises, payment stability, no risk of higher rates, nothing like that. The average or the most popular term in Canada last year was the 3-year fixed mortgage term, which offers a little bit more balance and short-term stability without the risk of breaking a mortgage if it's only 3 years versus 5 years, with the average Canadian breaking their mortgage at basically 3 years. I think every single year, it's always 33 to 38 months. So I think there's some value in that. But again, I think you'd be cautious on what type of lender you're picking and the terms associated with that. Why avoid a fixed rate right now? Really simple. If the BOC starts getting aggressive on rates, you're probably going to miss out on lower interest rates that you would have got and the flexibility that you get with a variable rate mortgage in this current market. Biggest thing, obviously, is those prepayment penalties. You really have to be careful with that. So if you want stability, predictability, think about that fixed interest rate, especially the 3-year. There's some great value, and the short-term risk could play off. If you are looking for opportunity, then 100% look at the variable rate mortgage right now. But just make sure you're considering adjustable versus variable, and you're checking on that compounding period, because that plays a big role in your total interest that you paid. I've seen a lot of people that I've talked to just didn't know that. And so something really to keep in mind. Again, if you're not sure about what that means, posted a video specifically on all the different rate dynamics last week on all of this stuff right here. So the question I ask you as a viewer out there, I've got a few questions. Number one, do you think we see the rate cut in March of this year? Or are you waiting for more rate cuts before you jump into the marketplace? Furthermore, are you thinking that the housing market will continue to go down until we see some stability in this tariff situation? Like, are we just going to continue to see listings and housing values remain relatively flat? I'd love to get some feedback from you in the audience about what your thoughts are in this situation. If you found this information valuable and you want to find out more, follow me on Instagram, where you can find out a little bit more about what's going on from a daily perspective. And I share a lot more of this data in my channel. You can follow me at The Mortgage Pug, and we'll see you on there.